It gives me great pleasure to bring on board Mr. Milind Karmarkar of Dalal and Broacha to understand where he views the economy is headed, markets are headed. He's a champion investor. He understands the entire consumption space. He's identified many multi-bagger ideas for his clients, including Trent and others. So let's connect with him to understand how markets are positioned for the coming summit here. Mr. Karmarkar, fantastic to have you on ET now. Wishing you, your
Thank you.
family, and everyone a very happy Diwali from all of us.
Thank you. Same to you. How have you been?
All well, Mr. Karmakar. So good to have you back. I'll start with something which you've always, in a sense, referred to, that watch out for Tata Group of companies. They are in the process of getting re-rated, and those stocks have got re-rated. What is the way forward for Tata Group of companies? Because that's where P expansion, participation, and also restructuring has happened. Is the best of Tata Group, not in terms of profitability, but is the best for Tata Group stocks now behind us?
So Tata Group, if we look at, basically, if you look at whether it's Tata Consumer, whether it's Trent, whether it's Titan, whether it's Tata Motors, all of them depend on or benefit out of rising per capita income, which has been my sort of theme for a very long period of time and continues to be that. So because of that, I think Tata Group overall should continue to do very well. Though besides these, they also have Tata Steel, they have Tata Chemicals, they have TCS. So as far as commodities are concerned, I think they have done very well in last few years, but maybe they will continue to do well for some time. But I think the bull run in commodities probably is coming to an end. But otherwise, rest of the pack in the Tata Group, I expect to do very well.
Why do you think the bull run in commodities is coming to an end? Because if one looks at the big picture is that because of ESG constraints, there would be a constraint in how much China can expand and how much other companies can expand, which means supply will always be less.
So I'm not saying that bull run. Actually, bull run will come to an end, and the commodity prices. What I'm saying is that commodity prices, which had moved up significantly, may not move up significantly from these levels. Because if we look at the past, the way most of these economic cycles basically move is first the commodities go up, then commodities come down, commodified products go up, then commodified products come down, industrial products go up. So when I'm saying come down, they probably stagnate then. Then industrial products, then you have, in between you have sectors like hotels and everything going up. So I think same thing is being repeated right now.
Across the board, commodity consumers have reported a drop in margins. They are feeling the heat of high commodity prices.
Correct.
Do you think one should use the downturn to look at the other side of the equation? If commodity prices they remain flat, it's a good time to buy into commodity consumers, because top line is not a problem. It is only at the margin level where they are getting squeezed.
I completely agree with you, because I think that if as commodity prices sort of stagnate, users of commodity will definitely benefit, and users of commodity is something which one should look at.
Mr. Karmakar, for the longest time, like you referred in your opening remark, that you have been a big votary of per capita income.
Yeah.
But for the first time, serious per capita is getting created because jobs are getting created. The corporate balance sheet recession is getting over. IT companies are hiring, and we, in a sense, are moving up the value chain because of the startup economy.
Correct.
What will be the first beneficiary of this entire job creation boom which is getting created, the wealth effect which is getting created now?
So I think we also had a stagnating real estate market over a longer period of time. So I think that as commodity prices stabilize and as interest rates have come down quite a bit, I'm not saying they will remain at this level. They will start going up at this level. from this level. But even if that happens, they are still significantly lower than what they were earlier. And because of that, I do see some kind of traction coming in. It has already started coming in real estate. So I think real estate could be a big beneficiary. And apart from that, I think all the other consumption stocks or consumption sectors. So uh, whether it's retail, whether it's FMCG, I am still slightly worried about. Not worried, but the growth will be probably lower as compared to the other sectors. But otherwise, most of the other sectors in consumption will do well, because another thing which typically happens is that affordability goes up as your per capita income goes up. Let me uh, just talk about oil, because oil, everyone says that oil will has the capacity to derange the economy and things like that, derail the economy and things like that. So if I go back to, let's say, 2002-3, oil was roughly about so $450 was the income, and oil was $30. So per capita income was 15 times the price of a barrel of oil. Today it's 24 times the per capita income is 24 times the price of barrel of an oil. So as your per capita income goes up, your affordability also goes up, and that is what basically drives consumption and drives the economy as well.
Are you a big votary of these new themes? EV, climate change, fintech?
So when it comes to fintech, yes, I am. When it comes to EVs, yes, I think that is the way to go. But having said that, especially for EV, the issue is that they will be replacing ICs. So, and most of these companies which are getting into EVs are already IC vehicle manufacturing companies. So for them, the growth will come out of a probably slightly higher priced vehicle. But in terms of volumes, I don't see a significant jump immediately. It will happen over a period of time. When it comes to climate change, the other day someone asked me that why don't you focus only on ESG investing? So my answer to that was simple. I said that uh, do you want to earn more money, or do you want to be socially more conscious, especially when you are investing? So obviously, his answer was to earn more money. So I said, you got your answer. So ESG, yes, one should be conscious of the environment, but I don't think ESG will be a theme over a longer period of time to uh, sort of grow and make more money in the stock market.
Which means that it makes sense to buy an ITC. I don't know if you own it, but I'm saying that if your view is that ESG investing is overdone and other non-ESG stocks are getting a stepmotherly treatment, time to buy an ITC, NTPC, Coal India.
So I basically focus on growth, because ultimately it's growth which drives the overall economy, and growth which drives the markets. That is the reason why I will focus more on companies which can show higher growth because of rising per capita income. So yes, power demand could go up significantly. Now here a thing comes in, which is the future production in electricity. Will it be driven by renewable energy, or will it be driven by thermal energy? I believe that it will be driven by renewable energy. And that is why maybe over a longer period of time, companies like, who are producers of uh, commodities which used to drive thermal electricity, they may not grow that much. So my focus would be probably on those companies which will benefit out of rising per capita income, rising per capita demand of power, rather than going in for power producers alone.
Companies like Nike and Zomato are also play on consumer and growth. High growth companies completely consumer focused. Nike play on
Yes.
per capita as well as grooming habits.
Correct.
Zomato growth, a play on food, as well as our growing habits where Indians are going to be dining in more rather than going out more.
True.
How does that fit in for somebody who focuses on growth and believes in consumer uptick, consumer businesses?
So they could be interesting, but at the same time, I also look at companies where there could be free cash flows, may not be immediately, but over a slightly longer period. So that is the key. If the answer to that is that if I'm looking at a particular company and I don't foresee significant free cash flow coming in next 8-10 years, then I may not invest in that company, even if it's in fashion. So like Zomato, Amazon, for example, in the US during the internet boom or during the internet company boom, it was trading at $100, and then when the internet boom got over, it collapsed to about $20. And for it to go above $100 took almost 10 or 11 years. So I'll be quite careful while investing in these companies, especially at high valuations.
How would you look at pure staples? You've been a big votary that look, P is not the only way how you look at benchmarks.
Yes.
P is not the only way how you look at valuations. But when the consumer demand is coming back, when the boom in the housing sector is coming back, do you think good old Asian Paints, Pidilite, Kajaria, will that space do well?
Yes, I think that should do well, because I'll tell you my basic theory is that we will reach the what everyone is talking about, the $5 trillion economy. Is it a pipe dream? My answer to that is no, because if one goes back again to 2002 to 2007, we see that actual GDP of India as per World Bank in dollar terms actually went up by 2.5 times. So if I try and put some logic to it, it's very clear that though GDP grew at about 7.5-8%, it was also helped by a significant fall in dollar vis-a-vis rupee. So dollar came down from 47 to 40, and that drove the per capita or even overall GDP of the country. So what happens is that when the environment is such that if your GDP is likely to grow at 8.5%, automatically the corollary to that will be that your currency will strengthen, and that is the reason why I think it's in the realm of possibility that in next 6 to 7 years, our GDP could go up by about 2.5 times. So we may reach the $5,000 per capita. And if that happens, then even staples will do very well.
You bought into insurance companies, especially life insurance companies, but they are going through a downturn. COVID write-offs, top line has been sluggish, underwriting cost has gone higher. What is your view there, given that LIC IP hopefully should see light of the day before March?
Yeah. So fear is the time to invest. It's a great opportunity also, and I think insurance as a sector in India is likely to do very well. I mean, I'm convinced that it can grow at about 18-20% year on year for quite a long time, maybe even 15-20 years. And when you are looking at such time of looking at this type of a sector where long-term 18 to 20% growth is possible, then you use this as an opportunity to invest more. I agree that it could underperform. It has been underperforming, frankly, for last probably 1 year, and it could underperform for another 6 months also. I don't know, but a long-term view is extremely positive on insurance.
Who will be the ultimate wealth creator in the financial world in next couple of years? For example, I'm just using it for benefit of our viewers.
Yeah.
If you bought into a private bank, let's say at the beginning of the last decade, 2010, top 3-4 private banks, and you just held on to them, the wealth creation was significant. So if somebody has to say that, look, What should I buy within financials? Could it be a disruptive player like fintech or policy bazaar? Should one bet on a comeback of corporate banks like SBI and Bank of Baroda, or keep it simple with an HDFC Bank and an Kotak?
So I think that fintech is the way to go, because I think that is what those will be the companies which will show significant growth over a longer period of time. So a combination of fintech and retail centric banks could deliver a fantastic return going ahead.
What is your view on those who are recommending buy cyclicals, buy industrials, capex cycle is about to start, the corporate recession is getting over finally after many years now, and that's where the earnings surprise would be?
So I have always said that cyclicals is something where my expertise doesn't lie. But having said that, I think we are already towards the end of the cyclical. And it's now that what will drive the economy and the economic growth is, of course, the uh, per capita consumption. Having said that, within industrials, there could be some segments which could do well, especially because the government is going to spend large amounts in the power sector and also in the railways. So one could look at some of the larger companies which are present in especially these sectors. Again, I'm saying I'm not so comfortable with the generators, but generators in the sense generators of power, not power. So power generating companies. So I'm not so comfortable with them because they are frankly fixed ROE businesses. So that is why I'm not so gung ho about them. But the others which supply equipment to the power sector or something like power exchanges, they could be interesting.
Where is your favorite stock trend headed in this decade?
I'm still extremely positive on Trent because Trent has a turnover of about 2,500 crores as of now. So looking at the increasing per capita income, looking at the opportunity which it has in the other joint venture companies, and I'm talking more of Star Bazaar, uh, there's a humongous opportunity there. So I'm very confident that it can grow comfortably at a very reasonable pace. Especially looking at the rising per capita. Yes, I am quite confident.
But Mr. Karmakar, big returns are made when you have earning expansion and P expansion. For some of
Yeah.
the consumer names, retail names, the P expansion is unlikely to happen. And if interest rates go higher, there would be in PE moderation. Can investors make money in that kind of an environment while you may get 15-20% growth, but the P multiples are likely to not expand any further?
So P multiples may or may not expand. I completely agree with you. But if a company is growing at 30% year on year for next, so in 3 years or 2.5 years, its turnover could double, its profits could double. Compound that for another 4 or 5 years, and the company will continue to do very well. So as long as I have confidence in companies that they can show significant growth going forward, I will continue to hold companies where the PEs are high, provided they are profitable and they are likely to grow at a pretty fast pace. So if you have a GDP which is growing nominally at 12-13%, and these companies are growing at say 30%, I think you will get significant value out of these companies.
Mr. Karmarkar, let's talk about the big picture. We normally start with the big picture, but I'm keeping this for the last leg of the interview. What stage of the bull market we are in? Because every bull market follows a stage. extreme pessimism and disbelief, then recognition, overextension, euphoria and bubble. Where are we in that bull market cycle?
Okay, so last November also there was a disbelief when the index was at Nifty was at around 13,000 or 12,000. I don't remember. But so if I look at parallels, I always try and do that, trying to search for anecdotal evidence. So if I go to because I do believe that the environment, economic environment is very similar to what it was post 2001 2. And so if I look at that, there between 2002 and or 2001 and 2005, in 4 years' time, the index doubled. If I look now in last 4 years, 2017 to 2021, index doubled. But at that time, we had a very strong GDP growth from 2004 onwards. And we are likely to see a similar GDP growth now. So after the index doubled in 4 years, in the next 3 years, it went up by 2.75 times. So I don't think this time it's any different.
So for next 3 years, what is the possibility, not a probability, what is the possibility on a scale of 1 to 10 that markets can give double-digit returns, CAGR?
At least 8 out of 10.
Okay, and this is after the base effect which would kick in.
So there is nothing like base effect, Nikunj, because base effect is there in the GDP also. So if your GDP was at $450 in 2001-2, and today it's at $2,000, there is a base effect in GDP. But if you look by global standards, or if you look at the opportunity, as I said, that the GDP can maybe go up 2.5 times in next 5-6 years. And if that happens, then market will go significantly higher than 2.5 times. And that is what gives me confidence that we will have a very strong market growth also. I'm not saying that markets will go in straight line. There will be corrections. So if you go back to 2003 to 2008, we had at least 4 times, if I'm not mistaken, that the correction was anywhere between 12 to 20%. We have seen only one similar correction which came in because of COVID. So I wouldn't be surprised if we have some more corrections going forward. But if you are asking me from point to point, I think market could definitely give double-digit returns for next 3 years, CAGR.
Final question, Mr. Karmarkar. We rarely talk. You do very limited media appearances. Every time we've spoken, you've said that, look, I hardly change my portfolio because I invest with a 3 to 5 year time frame minimum. But market conditions are dynamic. Boom and bust cycles are getting created. Stocks fly 15-20% on a weekly basis. Given how things have become very concentrated, technology is enabling and compressing trends. Have you reduced your time horizon of 5 to 7 to 2 to 3? And if yes, in last 6 months, what changes you've done to your portfolio?
So my exposure to consumption remains same, because I do believe that there are times when you will underperform the markets. Though fortunately I have been able to outperform, but you do underperform the markets with a 6 months, sometime 1 year, sometime 1.5 years, because especially in say last 2 years, if you see, commodity stocks have done significantly well, and if you don't have commodity, probably it is possible that one particular portfolio could underperform. But I also believe that in the longer term, those stocks where a lot of growth is possible, and which basically are managed by a decent set of managers, these type of stocks give you significantly higher returns over a longer period of time, basically because of the compounding effect. So sometimes even 3 years may not be sufficient for you to see that kind of a growth. But for example, for example Trent. Trent in 2003 was 60 rupees, 10 rupee paid up. Today it's about 1050, 1 rupee paid up. Look at Titan also. 40 rupees, 10 rupee paid up to 2,400, 1 rupee paid up. And these stocks have underperformed in between for maybe a couple of years. But over a longer period of time, the CAGR which they give is mind-boggling. So that is the reason why I prefer to hold my stocks as long as I'm confident that these stocks will do well. Coming to your question on have I made any changes in the portfolio? Yes, I have made some changes in the portfolio where we did include sectors like hotels in our portfolio because we thought that because of the pandemic, hotels were available at a very low price, considering the opportunity which was there as the pandemic receded. So we went and bought hotels when we were certain that vaccine is likely to come out. So that was last November, and they have done pretty well. So we do look at these and do changes in our portfolio as and when required. So we would be getting out of certain stocks, but the core portfolio, which probably is consumption, will continue to remain. We will continue to hold it unless until we think that per capita income is slowing down or the kind of growth which we had expected in a particular company is not coming in. Then we could think of exit.
All right, Mr. Karmarkar, really appreciate your time. Wish you happy Diwali once again, and thank you for your valuable inputs.
Thank you, Nikunj, and wish you and everyone at ET Now a very happy Diwali and of course a very prosperous Diwali. Thank you.
ET Now स्वदेश पर दिवाली धमाका। ET Now स्वदेश देखो, सोना जीतो। हर दिन सोना जीतने का मौका। सुबह 8 से शाम 4 बजे तक हर घंटे पूछे जाएंगे सवाल। SMS करें DD स्पेस आपका नाम स्पेस आपका ऑप्शन 56161 पर। हर दिन 5 लकी विनर्स को मिलेगा डिजिटल गोल्ड। एक बम्पर विनर को दिग्गज मार्केट एक्सपर्ट विजय केडिया और नीलेश शाह से मिलेगी अपने पोर्टफोलियो पर सलाह।